A newer thing that's kind of in the marketplace started to inch its way in 2015 and is really growing in size. Last year, somewhere between $2 and $3 billion of these loans were done.
Oh.
And what this is called a home equity investment.
Okay.
So HEI is the common thing there, but home equity investment loans.
This is Las Vegas Real Estate Now with local real estate expert Harvey Blankfeld.
You found out about this product that's being offered out there that
it's
raised
worth talking about.
Kind of raised your eyebrows a bit, didn't it?
It did. Yeah, like my warning bells went off just from being in the industry.
Tell me what this is about.
So we're at a point in time where we have many people out there with a good amount of equity in their homes, and they are looking for solutions to tap into that equity for whatever reason, whether it be remodeling, they pay off other debts, or deal with other sort of issues. And the common solutions that have always existed are, well, you could refinance your whole first mortgage that you have into a new one, take some money out. That's an option. People are resistant to that because many of them have very, very attractive interest rates, right? 2s and 3s compared to what you might get today.
Yeah.
And so they're not happy about that necessarily as a solution. The next most common solution is the HELOCs that are out there, home equity lines of credit. And these basically are a second mortgage that goes on your home. You have a monthly payment that you're paying for it. You have a line of credit that you can use and pay back however you need for a certain number of years. And those are sort of widely available. I think most people know about those.
Right.
A newer thing that's kind of in the marketplace started to inch its way in 2015 and is really growing in size. Last year, somewhere between $2 and $3 billion of these loans were done.
Oh.
And what this is called a home equity investment.
Okay.
So HEI is the common thing there, but home equity investment loans. So this is Wall Street hedge funds put together some cash, and they are willing to come to you as a seller. So Harvey, your house, let's pretend you want to get $50,000, right, out of that, and you don't want to touch first. You don't want to get a HELOC. Maybe you don't want that stuff, and so you hear about this home equity investment loan, and they're saying we can give you the $50,000, and you don't have to make us a monthly payment. We're buying into effectively the upside on your house. We're going to be your partner in the appreciation of that home over time. And you get to keep this money, this $50,000 that we're giving you, for somewhere between 10 and as much as 30 years, and you don't have to pay a payment on it.
Wow.
Eventually, when the money comes due, you're going to pay me back my money plus some upside.
Okay.
Right? And so this is quite attractive to people who are really looking for ways to make their bills and their finances better by, I don't want to bring on a monthly payment. I can do this without, costing me more money on a monthly basis. And they're willing to give me this money. That's great. And they're going to sit there as my partner in this house until such time as I sell it, I refinance it, or I just choose to pay back the loan. And so you have to look beyond how these loans are being sold to you and look at sort of the details. And there is a ton of variation from investor to investor. So this is not a one-size-fits-all product. This is a custom product that each of these businesses are coming up with. So they have their own ways to create rule sets and this sort of thing. But ultimately, what we're seeing, and you can check this on the CFPB's website, they have a nice article summarizing these loans, but ultimately, the cost of these loans could be very, very expensive.
I was going to say, how do you figure that? I mean,
somebody's willing to give you 50 grand and wait 10 years to get $1 back from you.
Yeah,
really?
Yeah.
Or 30 years and get $1 back from you. So they get their money back and they want their profit. And if you average it out, it's nearly 20% a year.
Whoa.
They want.
So in 5 years, you're doubling the amount. You basically, you owe them, instead of 50, now I owe them 100.
Yes, it could end up being huge dollars. So that's the big sort of thing is like, yes, you don't have to make a payment. And frequently these loans don't allow you to make a monthly payment or any kind of partial payment. It's pay in full or nothing.
Wow.
Because and a lot of these contracts are structured to where they have a floor, a minimum of how much they're going to make on you. And then as much more based upon how long you actually keep that loan. But there's going to be a floor as well as a ceiling on how much profit that they can make from you. And this could be far, far more expensive if you played it out over time than any kind of traditional loan.
Yeah, I mean, 20% per year does not match appreciation rates.
Yeah, it could very frequently exceed those, right?
Clearly,
Yep.
and so therefore, when you sell your house 10 years from now, you may not have enough money to pay them back.
It's possible, right?
Yeah.
The house could go down in value, could go up.
Even
in
if
value.
it went up at normal rates, you
Right.
probably wouldn't have enough money. I
Right.
mean, unless you had a big chunk of equity to begin with. Maybe you do, but even then, you're just lost. You basically traded it off for that 50 grand. That's
Sure.
That's a tough trade.
Yeah. So these loans, there's a few things. If you were to get one of these loans, it's not a monthly payment you're paying. Great, that's a highlight, right? But should you want to refinance your house or do something with your house, they have a claim to it, and
Right.
you have to deal with them. So
Yeah.
if you wanted to refinance your mortgage and deal with that, you have to pay them off. If you want to sell that house, they get their money first,
Right.
and then whatever's left goes to you.
Wow.
And so this is like, regardless of what you owe on your house, they want their chunk of money, whatever that math says you owe. And these contracts are so complicated
I was gonna say.
as to really easily have somebody make a decision and not understand all the possible sort of permutations of it and complications of it.
It sounds a little. I mean, it's very usury in terms of the way it sounds. It sounds almost like a loan shark.
It can feel that way in a way.
It does. It really.
I just don't want people going into these loans and being like, it's a miracle loan because
Right.
I get all this money. I don't have to, I can stay in my house as long as I want.
And I don't
all
have to
these
pay it
things.
back.
Right. But eventually they have an end date and all of it comes due
Wow.
at one time.
And it's not just 20% over the life of the loan. It's 20% every year you carry that, and that's where it really
Correct.
That's going to gobble you up, man.
Yeah,
That's
it
brutal.
can be hundreds of thousands of dollars over a long enough time frame,
Yeah.
and for a very small amount of money. You know, it's normal in a regular mortgage, like your traditional 30-year fixed mortgage, where you'll pay back about double what you borrowed.
Indeed. Yeah.
Right?
Yep.
If you do the amortization on a 30-year fix, you borrow $200,000, you're over 30 years, you're going to pay back $400, right?
Right.
That's a very typical answer. In these loans, it could be 5 times what you borrowed when you pay back. It can be. And there may be some good deals out there in the world. I don't want to badmouth it entirely, this kind of thing. But you want to go in this very, very carefully when you look at these loans. It's not all, roses and rainbows.
The people offering these loans are people who are very smart. They know how to
Yes.
make a lot of money.
Yep.
That's their job.
This is Wall Street hedge funds.
This is what they do. They're there to take. I mean, and so ultimately, Wall Street first they start buying up investment properties and leasing them out and flipping them or whatever. They realize there's lots of money to be made in residential real estate. Now they're looking for different angles to it for even those who own it because they can't buy everything.
Yep.
So now
They
this
do
is
have
another
the
way
power
to do
to
it.
foreclose,
Yep.
that sort of stuff, if
Wow.
they're not paid when they're owed. And they have all these sort of powers that can be sort of scary to people. But they see their numbers projected to getting to be $200 billion in business as an industry.
Wow.
So it's only going to get larger from here and
Yeah.
get more popular. So you see
it's-
these things on social or somewhere.
Because
just
the big
keep your
print
guard up.
is, hey, we're going to give you $50,000 and you don't have to pay us any monthly payments.
Correct.
And then here's the small print. Oh, by the way, you owe us 20% every year for the rest of the blah, blah, blah. That's the way it's going to be
you
presented.
only keep it 1 year. Well, we're still getting 3 years of profit on you. You have to, like, there's all these contractual terms in there, and there is not a federal regulator out there running that show other than the CFPB, which is currently neutered.
Yeah, they're not they can't do anything.
They're not allowed to do anything right now.
Well, John, you know what? This is the reason we do the show. Thanks for bringing this because I want our listeners to get that. If there's someone out there who's been thinking about that type of loan, make sure you're looking at a HELOC, make sure you're looking at other options and comparing and contrasting and penciling them out and make sure you understand the nature of what it is you're getting yourself involved with because honestly, that's scary. That's really scary. And I can see a lot of people not reading the fine print and coming to the end of this story with no money,
shocked,
and having no money when they sell their house,
Right.
and looking to buy another house and having no money to buy it with.
Yep.
And that would be just awful. That's a scary proposition.